Welcome to our channel. Australia's interest rates just dropped again, and if you're thinking of buying or refinancing, you're probably asking, should I lock in a fixed rate now, or wait to see if rates fall further? In this video, we'll unpack what this rate cut means, the pros and cons of locking in now, and what smart borrowers are doing in 2025. Make sure to stick around till the end because I'll be sharing a bonus tip that most borrowers overlook, one that could save you thousands down the line. What just happened? In May 2025, the RBA cut the official cash rate by 0.25%, bringing it to 3.85%, the lowest we've seen in almost 2 years. This is in response to easing inflation and some global uncertainty. Major banks like CBA and ANZ have already passed on the rate cut to variable home loan customers. So now the big question is, what should you do next? Let's talk strategy. When rates drop, it's tempting to lock in a fixed rate to secure the low. But here's the thing, lenders price in expectations, meaning most fixed rates today already assume future cuts or stability. So sometimes fixed rates are higher than current variable rates. Choosing to lock in isn't just about chasing the lowest number, it's about predictability and risk tolerance. So let's dive into the advantages of locking in a fixed interest rate, especially now that the RBA has dropped rates. You might be thinking, isn't it better to keep things flexible? Well, for a lot of borrowers, especially first home buyers or families on a tight budget, a fixed rate can actually be a really smart move. Here's why. The biggest benefit is certainty. When you fix your rate, your monthly repayments stay exactly the same for the entire fixed term, whether that's 1 year, 3 years, or even 5. No surprises and no worrying about next month's RBA decision. And for people who like to plan ahead, maybe you're budgeting for a new baby, a renovation, or just trying to avoid financial stress, knowing exactly what your home loan will cost every month gives huge peace of mind. Next, protection. Right now, rates have dropped, but we don't know for sure if they'll stay down. If the economy bounces back quicker than expected or global events push inflation back up, the RBA could lift rates again. If that happens and you're on a variable loan, your repayments will rise with it. But if you've locked in a fixed rate, you're protected. You won't be impacted by those increases during your fixed term. And third, fixed rates make budgeting easier. This is especially useful if you're on a single income, you're managing other debts like car loans or HEX help, or you simply prefer financial stability over chasing the best rate. Some of my clients who are self-employed or working casual hours love fixed rates for this reason. They don't have to stress over income fluctuations matching changing repayments. All right, now that we've covered the upsides of fixing your rate, let's talk about the downsides. Because as great as it sounds to lock it in, there are a few things you need to be aware of before you commit. First, let's talk about break fees. If you decide to end your fixed rate early, maybe because you want to refinance, sell your property, or even pay off your loan faster, you could be hit with hefty exit costs. And I'm not talking a few $100s. In some cases, these fees can run into the thousands, especially if rates have fallen since you locked in. Why? Because the bank loses out on interest they expected to earn from you, so they pass that cost back on to you. So if there's any chance you'll want to refinance, upgrade homes, or switch lenders in the next couple of years, think very carefully before fixing. Second, and this is a big one in 2025, you might miss out on further savings. Right now, we've just seen a rate drop, but some economists believe there could be another one coming. If you lock in today's fixed rate and then variable rates drop again, you're stuck paying more than the market rate. That's why some borrowers feel like they're locked out of better deals while their friends on variable loans are enjoying lower monthly repayments. Third, flexibility is reduced. Most fixed-rate loans come with strict limits on how much extra you can repay each year. Some lenders cap it at $10,000 or $20,000 annually, and anything more might trigger a fee. So if you're the type of person who wants to throw extra cash into your mortgage when you get a bonus or a tax return, fixing might restrict that freedom. Also, features like redraw facilities and offset accounts are usually more limited or not available at all with fixed loans. And finally, timing the market is tricky. A lot of people try to lock in at the bottom, but honestly, it's almost impossible to know when that is. Fixed rates are set based on future expectations, not just today's cash rate. So by the time you hear rates are dropping, the fixed rate might already have gone up in anticipation. This is where it helps to talk to a broker who knows the market and who can tell you if a fixed rate you're offered is actually competitive or not. So yeah, fixed rates can offer peace of mind, but they also come with strings attached. That's why a lot of smart borrowers in 2025 are splitting their loan, going half fixed, half variable, to keep some flexibility while locking in a portion. Alright, as promised, here's your bonus tip. You can actually split your home loan. That means part of your loan is on a fixed rate and the other part stays variable. This gives you the best of both worlds, stability on one side and flexibility plus potential savings on the other. If you're unsure about locking everything in, a split loan is something to ask your broker about. Thank you so much for sticking around until the end. We really appreciate your time. If you found this video helpful, please like, subscribe, and share it with your friends or family. Be part of the Fortis community, where we turn financial knowledge into everyday confidence. Need guidance on your financial journey? Reach out to us anytime at finance@fortiscapital.com.au.